So I'll go to chapter 4 on cost management techniques. In cost management techniques, there are multiple aspects. We will today start with something called as target costing. So I have some problem based area there. So I'll focus on target costing. Next class again we'll continue with target costing. I'm yet to do 2-3 small areas in chapter 3 which is entirely theory based. There's something called as Six Sigma. There's something called as cellular manufacturing and BPR versus PI. All of that is going to be purely theory based area. This chapter also has some theory based area, some problem based area. So we'll first do something called as target costing. Now I'll explain first the approach of target costing. I would have touched upon this at multiple places. What target costing has now said is that earlier the equation used to be this: cost plus profit is equal to selling price. That is, you calculate the cost of your product, add the profit margin and fix the selling price. This is what people have been used to doing it. Now first thing which happens is selling price. Who determines the selling price? Not me. It is determined by the market. Market determines the selling price. Second thing is profit. Management will say how much profit you want to earn. So market has determined selling price as 120. You want a profit of 20 rupees. Target cost 100 rupees. Actual cost 110. Actual cost is 110. Now, so first step is finding out the selling price. Second step is finding out the profit margin. Third step is finding out the target cost. Fourth is finding out the actual cost and see whether your actual is in line with the target cost. If no, do something called as value engineering. What is value engineering? Is analysis of your processes to eliminate non-value added activity. This is on day 1. Periodically you will keep doing value engineering, which is called as Kaizen costing, which is technically called as Kaizen costing, wherein you keep doing it on a steady state basis. Steps in target costing: setting of target selling price, determination of target cost. What is determination of target cost? Is target selling price minus the target profit, estimating the actual cost, comparison of actual cost with the targeted cost. No, this is okay. Comparison of target cost, comparison of target cost with actual cost. So I will compare what is the target cost of the company with the actual cost and then decide is there a need for reducing the cost, and if I have to reduce it, I will have to do value engineering or value analysis. What is value engineering? Is analyzing your processes in such a way that you end up eliminating all non-value added activity. In the practical world, this is what works most of the time now. What works most of the time is selling price is determined by the market. I determine the target cost. I determine the margin based on the target cost, actual cost, and then use value engineering. Okay. Good morning, friends. Good morning, friends. Okay, let's continue with the cost management techniques. In this we have learnt one of the technique which is target costing. In target costing, I set a target selling price. Based on that, I calculate something called as a target cost, calculate the actual cost, try to bring down the cost using value engineering. This is what we had started with. Now today I am going to start with something called as cost control and cost reduction, and then I will go to life cycle costing. Now coming to cost control and cost reduction, these two were the primary thing which you would have learnt when costing would have started, when costing would have been explained to you. This costing is really bothered about cost ascertainment, cost control and cost reduction. Cost ascertainment means finding out the cost of a product, cost control is bringing it under control, and cost reduction is bringing about a permanent reduction in cost using value engineering. Cost reduction is always considered to be a better thing than cost control. What happens in case of a cost control is you set a budget and you don't allow your expense to go beyond that budget. When you do that, sometimes because of cost pressures, I may be forced to dilute on the quality side, because I have set a cost saying and that my cost should not go beyond that level. That's a target which I have set in, and my performance has to be within that target which is set in. I cannot exceed that target which has been set in by the company. So somewhere there can be some kind of quality deterioration which can happen. So cost control is critical. It can be used for a short period of time. An example of cost control is standard costing, variance analysis, budgetary control. All these are part of cost control. Here you ensure that the costs do not go beyond a specified level. Cost reduction is more like a corrective action. Control is like a preventive action. You ensure that the costs do not exceed this level. Cost reduction is bringing about changes in my manufacturing process, changes in my delivery process. When I bring about changes in all of this, cost will automatically come down. The objective is to reduce cost by changing processes rather than by controlling the cost. So that is what we are going to learn. Cost control implies regulation of cost by executive action. For this purpose, the executives are provided with some yardsticks such as standards or budgets with the actual cost, and performances are compared to ascertain the degree of achievement made. Very simple. I will tell that this is the cost to be met, and I keep comparing that. When I keep comparing that, obviously we will take actions in such a way that our costs do not exceed the target which has been set in. Cost control is possible only when an organization has an effective cost accounting system. It is basically continuous comparison of actual with standards or budgets to regulate the former. Coming to cost reduction is real and permanent reduction in cost. There is no concept of a standard here. If you say standard cost is 100 rupees, cost reduction will say why 100, why can't it be 95, why can't it be 90, why can't it be 80. So there is no concept of a 100 rupee cost, or there is no concept of a 90 rupee cost. You try to reduce cost to the extent possible. That is what you end up doing in case of cost reduction. Cost reduction versus cost control. Cost control is achievement of real and permanent reduction in the unit cost of products manufactured. Cost control involves a comparison of actual with standards or budgets. This is what is the real crux. Apart from that, there are a lot of other differences which you can go through, but the crux is very simple. Reduction is the achievement of real and permanent reduction in cost. Cost control is a comparison of actuals with standards or budgets to regulate the actual cost. Clear? This is what we are going to do as far as cost control vis-a-vis cost reduction is concerned. I'll directly get into some problems now. Cost control and cost reduction. Classify the following items under the most appropriate category: cost control or cost reduction. Cost exceeding budgets or standards are investigated. Participate. Control reduction. Cost control. You do this, don't write in your workbook, you can use it for revision later on. Anyway, the solution are there in the other material. You keep noting down in your notebook if you want. Cost exceeding budgets or standards are investigated as cost control. Preventive function. Preventive function is always good, but in this case it's not good, because you prevent the cost from exceeding the budget through a concept called as cost control, whereas you should take a corrective action and reduce the cost. So preventive is control, corrective is cost reduction. Measures to standardize for increasing productivity. If I am improving productivity, it's a cost reduction, because this is going to be a real and permanent reduction in cost. Earlier you were doing audit through method A, now I have suggested method B, because of which your ability to conclude audit quicker has gone up. Audit may not be a very good example because there a lot of non-standardization is there, but in case of a manufacturing setup, if I am involving some measures and productivity can improve, that's more of a cost reduction. Provision of proper storage facilities for material. Okay, this is neither a cost control nor a cost reduction. So ICI is taken because you are providing the storage facility for material. There's no concept of a control or reduction here. ICI is taken as cost control. But I don't see this to be a concept of a cost control or a cost reduction. You're just providing storage facility for material, which you have to do. Continuous comparison of actuals. Cost control. Challenges the standard set. Cost reduction does not agree to the standards. If you say 100 rupees, it will ask you why 100, why not 80, why not 60. Value analysis. Value analysis. Cost reduction. Value analysis is comparing your actual cost with the target cost and trying to bring down the reducing all non-value added. If something is permanent in nature, it's cost reduction. If something is temporary in nature, it's cost control. Classic reduction. I'll go to the next concept, which is on product life cycle. An extremely important area from exam point of view. Questions have been frequently repeated from this area. Now coming to this area of product life cycle, you may have come across this in strategic management. A product goes through 4 stages. What are the 4 stages? Introduction, growth, maturity and decline. What product life cycle costing says is that first, if a product is going to go through 4 stages, please don't end up calculating profit at every stage. There will be stages where we will make losses. There will be stages where we will make high profits. There will be stages where the losses can even increase. So product life cycle costing says, when you analyze the profitability of a product, analyze the profitability for the entire life cycle, which could be 2 years, 1 year, 4 years, 3 years, 5 years, whatever is the life cycle, analyze the cost for the entire life cycle and then calculate the profit for the entire life cycle. So life cycle costing is not something which is new. You are going to do normal costing, but the costing would be done for the entire life cycle. It will start from 2019 and the costing will be done till 2024. So you will first find out units to be sold for the entire life cycle, cost per unit for the entire life cycle, and see how much profit we are going to make. In order to calculate the cost, I may use techniques of activity based costing if the costs are not directly traceable, or I may use the traditional costing approach. But net what we are required to calculate is, we are required to calculate what will be the cost per unit for the entire life cycle. Why we do this is, invariably in the introduction stage there will be losses for the company. So there is potential losses for the company in the introduction stage. So if I am able to do the costing for the entire life cycle, I will get to know whether the cost whether the company is going to make profits or not from this product introduction. Also, if profits are not going to be made, well in advance I can try to either reduce the cost, increase the selling price. So it is able, I can use this as a forecasting tool or as a planning tool and bring down my cost if needed. It will alert me before the issues are going to come in. Otherwise, I will just look at the introduction stage. If you use a skimming strategy, your introduction stage may look very rosy, but growth, maturity and decline are going to have a lot of problems. So it is always better to look at an overall level rather than looking at a stage level. Just a minute. Life cycle costing involves identification of the cost and revenues over a product's life cycle, that is from inception to life. Its objective is to maximize the profit generated from a product over its total life cycle. You have an introduction stage. When the product is introduced, you may be the only player in the market or some other competitors may exist, but you are going to enjoy the benefits of the new product which you are introducing. In a growth stage, lot of competitors will also come in. You will also be there. You may be forced to reduce the price in the growth stage, and competitors do something called as reverse engineering. They may do it in introduction stage, they may do it even in growth stage. What is reverse engineering is, the competitor will buy my product try to split the product and understand how the product has been manufactured and bring a similar product. You cannot avoid that. Though you may have patents, copyright and all, but a similar product may get introduced by my competitors. So introduction, then growth, then maturity is a stage where you see that market is maturing. You may not now try to do huge advertising expenditure because you see somewhere introduction stage is very low sales. Growth, there is a rapidly rising sales. Maturity, there will be high sales, but now sales increase itself will happen at a decreasing rate. The sales may increase, but it may happen at a decreasing rate, or the sales may decrease itself. In the decline state, sales are going to decrease. Competition is almost negligible and profits are non-existent. Sales began to expand rapidly. During the stage, sales continue to increase but at a decreasing rate. It continues to increase but at a decreasing rate, and this stage there is going to be decline in volume. Now, this characteristics and strategies of 4 stages. ICI asked a 20-mark case study on this, on the characteristics and stages of strategies of 4 stages. This is an extremely important area. What are going to be the characteristics of every stage and what kind of strategies companies can adopt in each of the stage. This is one area. Second area which gets asked as a case study, I can call it as case study in pricing decision or a case study in product life cycle. What is going to happen to the selling price in every stage? Will the selling price increase or decrease in every stage? I will discuss that in a case study. Also, what is going to happen to the production cost in every stage? What is going to happen to the sales and marketing cost in every stage? In the introduction stage, there will be a huge marketing expenditure. In the growth stage, maybe it can come down or it can even go up. So you have to comment on that. So that is one question which is normally tested. What happens to the selling price? What happens to the production cost? What happens to the sales and marketing cost as we move from stage to stage? Now, these are the various characteristics. These will be self-explanatory. You can go through this. Come to page 88. Go through the characteristics and strategies. Different characteristics of the 4 stages and the strategies. Okay, let's continue. Basically, in the introduction stage, I might be the only player, few competitors can be there. I may have to do a huge promotion expenditure and high probability of making losses because you may not be getting profits out of the product. In the growth stage, competition intensifies, sales intensifies, Marketing may continue to be there. Earlier also I do a huge promotion expenditure, I may continue to do the marketing expenditure, and my profits will also keep increasing and sales will rapidly rise. In the maturity state, sales is now going to become stagnant. Competitors may try to move out now of the market because they will feel that there's nothing much in the market to continue now. Slowly the competitors will come down. You will also try to reduce on the marketing expenditure, and finally in the decline sales you will avoid the marketing expenditure to the extent possible, and whoever are the loyal customers, they will continue to buy my product. Now there are certain characteristics of product life cycle as such. What product life cycle says is that it is possible to estimate the cost over the entire life cycle. I can estimate the cost over the entire life cycle. Also these costs are kind of going to remain stagnant. These costs are going to kind of remain stagnant, or it is possible for me to predict the cost across the entire life cycle. And also other major factor which it says is different stages needs to have different strategies. You cannot adopt the same strategy across the various stages. Pass through a predictable courses through the product life cycle. Different threats and opportunities that give rise to different strategic actions. Now benefits of product life cycle costing is, when I do a life cycle costing, it helps me in a way to predict the sales over the entire life cycle. When I do that, I get to understand whether the product is going to be profitable or not over long term. It will also help me in wealth maximization, because this is going to tell whether I am going to make profits over the entire life cycle or not. That is the major benefit of life cycle costing. Apart from that, it can help in pricing decision. You can fix the price with the help of life cycle costing. You can try to reduce cost if needed. All of that will come, but the major thing is it helps in decision making, sometimes advancement of decision making. So product life cycle results in earlier action to generate revenue or lower cost than otherwise might be considered, better decisions, long term rewarding, which is what I was talking about, wealth maximization, long term picture of product line profitability. Uses of product life cycle is, there's something called as a forecasting tool. It is also a control tool. Control tool is, I can compare the performance of my product with like products in the market, with the competing products in the market. So that is where it is called as a control tool. Forecasting tool is to ensure to forecast the future sales of the product, but they are saying that past patterns are not available, so it may be difficult to forecast the future sale. There is a planning tool, there is a control tool and a forecasting tool. Planning tool is planning for the entire life cycle on the cost side as well as on the revenue side. Control tool is comparing my performance. Control means always ensuring that things are going fine. So control is comparing our performance with the other products which are there in the market, and forecasting is forecasting the sales pattern, which may not be that easy. Planning tool, it characterizes the marketing challenges in each stage and poses major alternative strategies. Allows the company to measure product performance against similar product launched in the past. Forecasting tool, it's less useful because sales histories exhibit diverse pattern and the stages vary in duration. Now let's get into problems or case studies in this. Clear? Okay, I'll come to the next area, which is on Pareto's analysis. I felt this to be an insignificant area, but ICI ended up asking a 10-mark exam question in the latest attempt on Pareto's analysis. I'll first explain what it means. Now, Pareto is an economist. What he said was that, I don't know which country, but he said that 80% of the income tax of the country is paid by 20% of the people. So what Pareto's analysis basically indicates is that if we have a problem in hand, try to focus on the most important aspect. If you focus on 20% of the items, you will end up getting 80% of the results. So from a government point of view, if they focus only on those 20% assessees, 80% income tax collection will happen smoothly, and you will ensure that there are no tax avoidance or tax evasion in those 20% case, which will give me 80% of the results. And modification of Pareto's analysis was ABC analysis, which you could have learnt at inter level, where you classify the materials into category A, category B and category C. Basically, Pareto's analysis is an exercise in selective control. I need to do a selective control. So I will have my products. I'll classify some of them as most important, some as moderately important, some are least important. Most important, MD will keep in his own control. If he has to control the pricing, volume, decision, everything MD will take care. Moderately important can be given to the middle level of management. The next level could be given to the lower level of management. We'll say that you take care of these products, because those products may not be that important from an MD's point of view, but could be important from that lower level management point of view. So I will have to do a selective control, and Pareto's analysis is basically an exercise in doing a selective control and ensuring a better control over various things. So now I can implement this Pareto's analysis for pricing decision. I can implement the Pareto's analysis for inventory control. I can implement it for product distribution, or also for customer profitability analysis, which customers are important. Finding out 80%, 20% of the customers who contribute to 80% of the profits. Direct product profitability analysis, finding 20% of the product which contribute to 80% of the profits, because there are certain products which will comprise only 20% of volume, but they may give 80% of the results. So Pareto's analysis is a rule that recommends focus on the most important aspects of the decision making. It is based on 80-20 or 70-30 rule. Pricing, customer profitability, inventory control, quality control. In all these places, I can end up adopting Pareto's analysis. Now, in Pareto's analysis, we construct something called as a Pareto's table and a Pareto's chart. What you do in a Pareto's table is you classify the items in the descending order of value. Now, a Pareto's chart can be based on sales. If you are doing it on base of sales, whatever products you have, classify them on the descending order of sales value. The highest product, the topmost product will come first, and then it keeps. A Pareto's chart can be done on contribution. If you are doing it on contribution, classify in the descending order of contribution. A Pareto's chart can be done for marks in an exam. Classify the various chapters in the descending order of the marks. A Pareto's chart can be done for defects. Classify the various items on the order of the defects. So whatever is the item you want to analyze, classify them in the descending order of the value, and find out which items will comprise 80% of the defects, which items is going to comprise 20% of the defect. Ignore the 20% item, focus on 80% of the item. Classify the 15 chapters of costing in such a way that you find out 80%, which chapters comprise 80% of the marks, which chapters comprise 20% of the marks. I may not focus much on the 20% one, I will focus more on the 80% one. That is what Pareto's analysis is all about. Write the various customers, descending order of value, find out the topmost customers which comprise 80% of the value, focus on them, ignore the balance 20%. This is what Pareto's chart is all about. So first we will put a table and then we construct a chart. So a chart can be on the bar chart or a stacked column, so you will understand when I create a chart. But first objective is to prepare a table and then I create a chart on top of that. Let's look at problems on this. Let's come to question 25. A toy company performs a Pareto analysis given a set of defect types, page 106, given a set of defect types and frequencies of their occurrence. Sample data consists of information about 84 defective items. Classify, the items have been classified by defect types, construct a Pareto chart. Go through this. This got tested in your recent exam for 10 marks. Not this question, but a similar question got tested in exam. Okay, first we'll create something called as a Pareto's table, where I classify, this is on defect, so I'll classify the defects, various types of defect in the descending order of value. Working note 1, Pareto table. Working note 1, Pareto's table. Four columns: defect type, number of occurrence, cumulative occurrence, and cumulative percentage. Defect type, number of occurrence, cumulative occurrence, and cumulative percentage. Defect type, number of occurrence, cumulative occurrence, and cumulative percentage. Descending order of value. The first one is surface scratch. Surface scratches 53. Next is cracks due to mishandling. Improper shape 8, incomplete 8, others 5. I've just written it in the descending order of the value. Cumulative occurrences 53, 53 plus 10, 63 plus 8, 71 plus 8, 79 plus 5. Cumulative values. Cumulative percentage is 53 on 84 into 100 to get it in percentage. 53 on 84. 63% of defects are due to surface scratch. 75% are due to surface scratch and crack. So if I have to get 75% result, I just need to focus on two items: surface scratch and crack. This can help me in eliminating 75% of the defects. If I want a 80% result, I will also try to reduce improper shapes. So that will help me in bringing down the cost or bringing down the defect percentage from 100 to less than 20. So my major area of focus is going to be surface scratch and cracks. Clear? Any doubts on this? Okay. Now I'll put it in a chart form. So let's write the various defects. Listen for some time. Surface scratch, crack, improper shape, incomplete, others. There are different way of showing this. Now surface scratch, I am putting a bar line. This is 53. Crack is some 10. You will need a proper graph to do this. 10. Then 8. This is 8. And this is 5. These are the kind of number of defects which are coming in. And I also have a secondary axis. Here it is 10, 20, 30 till 100%. So this starts with something like 63%. 75 it reaches here. 84 it reaches here. 92 it reaches here, and my 100% of the defects come here. So this is a secondary axis, this is a primary axis. So in primary axis I put a bar chart which is 53, 10, 10, 8 and 5, and then I put a line which tells about, this is a line for the cumulative frequency. This is the line for the cumulative frequency or the cumulative occurrences. It started with, this is basically a line of 63, 75, 84, 94 and 100. 63, 75, 84, 94 and 100. I'll show a better chart so that you understand it. Just give me a minute. This is what, there are multiple ways. Yeah, this is what they have also done. One is on the frequency side. which is 10, 20, 30, 40, 50, 60. Other side is percentage, which is 20, 40, 60, 80 and 100. Surface scratch, crack, improper shape, incomplete and others. And if you see, there is also a line which this number is basically starting from 63, 75, 84, 94 or whatever, 94 and 100. This is how this has been constructed. One side I put a bar diagram, other side I put a line to show this graph, and here below they have said vital few. These are the most important ones: surface scratch, crack and improper shape. The purpose of Pareto analysis is to direct attention to the area where best returns can be achieved by solving most of the quality problems just with a single action. In case good quality raw material, say plastic, may solve 63%, and if raw material is handled properly, 75% of the problems may overcome. Because I have surface scratch, which is because of a bad raw material, and cracks, if I try to handle raw material properly and have a better raw material, I'll achieve 75% of the results. Show this graph now. Show this graph. This is the graph. This is the Pareto's chart. %80% is kind of the cutoff which is there. I need to get 80% results. That's the target. It is available in your printed solution, but just once if you do, you'll at least understand what is to be done in case of a Pareto's chart. Okay. Good morning, friends. Okay, let's continue with the cost management techniques. As far as chapter 4 is concerned, we had started with target costing. Then in the last class, we saw the allied areas like cost control and cost reduction. We also saw life cycle costing. We have seen Pareto's analysis. Only area which is pending is environmental management accounting. So let's discuss today on that. Now coming to environmental management accounting. Environmental management accounting is based on another framework, another framework, which is triple bottom line framework. Though both has no linkage, but some part of triple bottom line framework comes here. Triple bottom line focused on three things. What are those? people, planet and profit. People is employees, which is social bottom line, planet is environmental bottom line, and profit is economic bottom line. This is what the TBL approach was focusing on. What environmental management accounting says is, whenever you do costing of a product, also consider the environmental impact your product is going to make, because every product we manufacture makes certain environmental impact, and we need to analyze how the environment is getting affected by our decisions. And also whenever there is an effect happening on the environment side, certain places the rules and regulations can become so stringent that you have to then spend money to prevent those issues which are happening to the environment. For example, in textile industry, there's a process called as dyeing. Dyeing is a process by which colors get added to your various fabrics which are there, and chemicals used to be coming out once the process gets over. Earlier, all these chemicals used to be technically called as effluents. They used to be mixed with sea. Suddenly regulations came in where an effluent treatment plant was to be put up by these players, because government didn't want them to affect the environment. So if I keep impacting the environment, somewhere somebody is going to act, either the government acts or the environmental protection organizations act. Because of that, I may have to start spending money on that. So when I'm doing analysis of a product, be cognizant of the fact that it can impact environment, and what is the cost of it impacts on the environment side. So your EMA is a process by which you combine your management accounting also for the, and also bringing into the environmental cost for the decision making purpose. Best management accounting thinking with best environmental management practice. Now EMA says that whatever you learn out of environmental management accounting, consider it for pricing decision, consider it for cost calculation, consider it for new product introduction, consider it for analyzing the profitability of the product. So there are various decisions which can be taken with the help of EMA. Please consider the environmental impact of anything which you take. And for whenever I'm analyzing a product, also be cognizant of the fact that how environment is going to be impacted by it. So I'll come to the example in a minute. Areas of application: product pricing, budgeting, investment appraisal, calculating cost, savings of environmental projects, or setting quantified performance target. Net it will be used for product pricing. Product pricing has a subset called as cost calculation. Product pricing has a subset called as investment analysis. So all of that is going to be subset, but net it has to be used for product pricing. One of the examples which we have is, a small town wants to build an electricity generating plant. The area gets a lot of wind and has plenty of coal under the ground. The town is locked in a debate over which energy source should be used. Half of the town feels that a wind energy power plant is the way to go, and the other half feels that coal burning power plant is the best option. Even though the town is split over the debate, they all want to come to the best decision and take into account all of the direct cost as well as the indirect cost to the environment and people's health. As a management accountant, you are required to help the town in deciding the type of the plant. Now in this example, what is happening is, somebody wants an electricity generating plant. I have two options, one to go with the wind, second is go with the coal. If I go with wind, it's a renewable source of energy. There are no major issues on the environment side. The solution just talks about that if you bring in wind may make some noise, and that noise may impact the people around them, and there is noise pollution associated with wind. When you go with coal, it will be emitting gases in the environment, so pollution will get affected, air pollution will get affected, so that is going to impact the air pollution. Consider these facts in your analysis and then go ahead and make a decision. I'm not making a decision, I'm just saying if you go with the wind has this issue, coal has this issue, please do consider this and then make your decision. Town is required to use the concept of environmental full cost accounting. Environmental cost accounting can be defined as a method that recognizes the direct and indirect economic, environmental, health and social cost. Economic is profit, environmental is planet, health and social is people. So people, planet and profit gets kind of combined here. Environmental full cost accounting considers more than just the basic direct costs associated, such as the also factors in indirect costs. Coal burning power plant will emit greenhouse gases that impose health cost on society. Noise that comes from the wind power generation could cause sleep disturbances, anxiety and stress in susceptible individuals. So I will have to consider all these indirect costs for the purpose of decision making. Simple thing, you have to consider these indirect costs for the purpose of decision making. That is what the limited point they are making. Now there are certain cost classification. There are multiple categories of cost classification. Different people have given different classification. The most important one is there is a classification called as environmental prevention cost, environmental appraisal cost, environmental internal failure cost, environmental external failure cost. We have seen this as prevention, appraisal, internal failure, external failure. Environmental prevention is those costs incurred to ensure that the environment is not impacted. Environmental appraisal cost is to inspect whether the environment is getting affected. Internal failure is impact is within the factory. External failure is outside the company. Apart from that, there are some other cost classification. Conventional, hidden, contingent relationship. This is one way of classifying. Conventional is basically raw materials and energy cost. Hidden is all your overheads. Normally what happens is any environmental related cost may get hidden in the form of overheads. Rather than showing it separately, it may lose its identity in the form of general overheads. Contingent cost is future cost which a company may have to incur, and relationship cost are all intangible cost. Then there is another classification, cost incurred to protect environment, cost of wasted material, capital and labor. The most important is environmental prevention, appraisal, internal failure and external failure cost. This is the most important classification. I have one is conventional, hidden, contingent and relationship. This is one way of classifying the cost. Second way of classifying the cost is cost incurred to protect the environment and cost incurred of the wasted men, material, machine and money. An internal cost is something which is going to impact my P&L statement. External is something which is not going to impact my P&L statement. But a lot of organizations a lot of governments do this. If you are polluting the environment, be ready to pay extra taxes. If you are taking care of the environment, government may give some subsidies also. So somewhere my external cost can get converted into internal cost if government wishes to. That's what they did with that effluent treatment introduction. Then you have prevention, preventing adverse environmental impact. Appraisal, determine whether products, process are compliant with environmental standards. Cost incurred from activities that have been produced but not discharged into the environment, that is impacting within the company, which is impacting outside the company. Now this is, we saw balanced scorecard. There were 4 perspectives in balanced scorecard. What were the 4 perspectives? Customer perspective, financial, internal operating efficiency, learning and growth or innovation perspective. Now they are saying organization should try to bring a 5th perspective called as environmental perspective in that balanced scorecard. In environmental perspective, what things I measure is how much of hazardous chemicals I am manufacturing, how much of toxic waste I am manufacturing. I should try to maximize something called as if I am manufacturing certain hazardous chemicals, I should try to treat them and not discharge them into the environment. Should try to treat those effluents which are getting manufactured and not discharge them into the environment. So minimize hazardous material, minimize energy, minimize release of subsidies, maximize recycling. Maximize recycling. You should try to maximize recycling to the extent possible. That is what environmental perspective of a balanced scorecard is going to talk about. Now I need to identify the environmental cost, because what kind of cost I am incurring. There are certain techniques which are there to measure the environmental cost. You will have to remember these techniques and reproduce as it is in the case study. The first technique is an input output analysis. What is input output analysis is, In an input-output analysis, you will measure how much input has gone into the process and how much output has been manufactured, and in the process what kind of wastage has happened by the company. Example is 100 kg has led to 80 kg of output. So there is a 20 kg of wastage which has happened. This is one technique called as input-output analysis, which will measure how much input has gone into the process and how much output has come out of the process and what kind of waste the company has done. You should try to minimize the wastage of resources to the extent possible. Second is a flow cost accounting, which is going to track the material from the inflow stage to the outflow stage. It's just going to track how the raw material is moving from the inflow stage to the various stages. Material flows transparent by using various data. It tracks material losses at various stages of production. Material cost, system cost, and delivery and disposal cost. So material cost is the direct cost of purchasing the material. System cost is those costs incurred to process the material, and your delivery and disposal cost is to deliver the good product and dispose the bad product. This is another cost classification. The third technique is life cycle costing. Fourth technique is activity based costing. In life cycle costing, it basically says is when you analyze the life cycle cost, also take cognizance of the environmental impact cost. And you can also use the concept called as TQM, which focuses on zero defect, zero waste, zero accident. So if that also happens, then I kind of avoid any issues on the environment side. Activity based costing is basically a technique which finds the right driver for the cost to take place. It basically finds the correct cost driver. So if I use activity based costing, it will help me in measuring the environment cost properly, and also it will help in minimizing the environmental cost. So ABC allocates internal cost to cost centers. Environmental accounting focus on distinguishing between environment related costs and environmental driven cost. Environmental driven costs are removed from general overheads and traced to product or services using some allocation basis. Most of the times it will get mixed with the normal cost. So you will have to remove it from the normal cost. Example, transportation cost. It will be taken as an environmental cost here. You will remove the fuel cost and show it as a separate line item. Otherwise, fuel cost will get clubbed with the production overheads, it may clubbed with the general overheads, it may get clubbed with the administrative overheads. So ABC will try to pull out those costs, show it separately, and have these drivers: volume of emission, toxicity of emission, environmental impact, relative cost of treating different kinds of emission. Now there are different types of environmental costs. There is a waste, there is a water, there is transport. So there are different kinds of costs. So how do I control those different types of costs is the next part. Waste can be controlled by an approach called as mass balance approach. This basically indicates how much waste has happened in the manufacturing process and how can you control the waste which is happening in the process. So waste is the first part of it. Second is water. Need not explain the importance of water. We very well know what kind of water shortage we are facing in our city. So next is water. So organization should try to reduce the usage of the water, and also if the water is used by the industrial organization, they should not release the waste water into seas, because if they release it, there is another further issue which is going to happen on the water side. So organization should identify where water is used and how consumption of water can be decreased. In fact, an organization pays 2 times for the water: one to buy the water, second to treat the water. I'll have to treat the water and send it out. I cannot treat it. Example, sewage treatment plant. I will have to treat it and then send the water out. I cannot be contaminating the water available in the next is energy. Energy is basically electricity. You would have seen a lot of advertisements where people say that conserve electricity, don't waste electricity. So we do see some advertisements like that because electricity is an important resource. Earlier there were a lot of villages where electricity was not even available. Now everything got electrified, but still there is a huge importance to the electricity and I should not be wasting them. So I will have to find inefficiencies and wasteful practices. Transport and travel is the next part, which I had earlier indicated. Transport and travel is because the air pollution impact. One is air pollution impact. Second is fuel availability is also on the limited side. We are a country which imports fuel from the other country, so I wouldn't want to waste so much fuel. Also increasingly there is some focus of the government to shift from a traditional fuel usage to electronic vehicles. E-vehicles are going to be the future because one, availability of fuel is an issue. Second, the kind of environmental impact it makes. And the last part is consumables and raw material. Now, why do organizations try to control this environmental impact? The major part is called as reducing carbon footprint, because carbon footprint basically indicates how much of greenhouse gases we are emitting in the atmosphere. So I would want to avoid that to the extent possible. That's the major thing. But it can also help me in cost reduction. It can give me certain subsidies. It can help me in better pricing of products. And it may also avoid certain tough penalties on me, because there can be some penalties which the government may charge if things are not going in the right direction. If I have to avoid those penalties also, I should try to look into this, something called as environmental cost accounting. Why organizations don't try to implement this is this may involve a huge infrastructure cost. That's one primary reason organizations may try to avoid this environmental cost accounting or environmental management accounting. Regulatory requirement, huge penalties for companies found guilty. These are the on advantages side. Advantages is improving revenue, cost reduction, increase in cost and cost of failure. So there is an increase in cost which will happen, and because of that I may decide not to adopt something called as environmental management accounting. If I am not adopting it, I should be ready to pay penalties in future. Classic example was textile industry, where something called as dyeing industry got impacted when the government said you have to treat the effluents. You cannot be always releasing it in the sea and contaminating that. So that is where an issue happened in that industry. Like this, a lot of industries can go through this problem.